Okay, we're going to go over the different entities that are available to a farmer. Most farmers, when they first start out, they start out as a sole proprietor. That means they file a Schedule F on their tax return. It's very easy. There's no extra tax returns to file. There's no wages that pay themselves. They simply report the income on Schedule F. You know, the drawback to this is all of the income of the farm flows through to their tax return and is subject to self-employment tax. Right now, if they're making, let's say, approximately $110,000, that self-employment tax is easily $15,000, assuming normal rates. After that, you know, a lot of farmers, especially with a husband and wife situation, will consider forming a partnership. You know, the partnership is very easy to get into. It's very easy to get out of. The issue with a partnership, and it's not an issue, is that now you have to file another tax return. It's called a 1065, and all the income of that partnership will then flow through to the farmer's tax return. After that, or starting about 25, 30 years ago, there was a new entity that came about called a limited liability company. And this is a unique structure from a tax standpoint. It is normally taxed like a partnership, but it's got the legal protection like a corporation, which we'll go into in a minute. However, a limited liability company can actually be taxed three different ways. If it's owned by just the farmer, not owned by him and his wife, or just the farmer, then it's treated as if it's a sole proprietor. If it's owned by the farmer and his kid, a farmer and another farmer, a farmer and his wife, as long as it's two or more people, then it's taxed as a partnership. However, if it's either owned by the farmer or owned by more than two people, they can elect to tax it as a corporation, which, you know, we have two different types of corporations. We have the regular corporation, which almost everybody refers to as a C corporation, because that's the code section, the chapter of the code, subchapter of the code that refers to corporations. The benefits of a C corporation, which are a lot, especially for a young farmer, is that the C corporation, the first $50,000 of taxable income is only taxed at 15%. Secondly, the corporation can grant certain tax-free fringe benefits to the farmer that the partnership, the sole proprietor, and an S corp, which we'll talk about, cannot grant to the farmer. It can provide meals to the farmer. It can provide lodging to the farmer. It can pay for the utilities. It can pay for a lot of medical expenses, et cetera, that the other entities are not allowed to deduct. And again, we're calling this a tax-free fringe benefit, so the farmer does not pick it up as a deduction. The drawback to the C corporation is that there is a double tax. You remember we were talking about the first $50,000 of taxable income being subject to a 15% tax. Well, when that income finally gets distributed to the farmer, and usually that happens at retirement, but it gets distributed to the farmer, that income is then subject to whatever the tax is on dividends. Right now that's 15%, but if the Bush tax cuts expire, that's scheduled to go back to being ordinary income rates. So that could be as high as 40% for federal, or actually it could be as high as 43% plus or minus for federal, plus your state rates. So those can add up pretty fast. And then the last corporation that we're going to talk about is an S corporation. And that is essentially a regular corporation that just makes a special election with the IRS. A lot of my farmer clients, they ask me, well, you know, when they talk about an S corporation, they're going, well, what do we file with the state, you know, and so on. The corporation is still the same with the state. The S corporation is simply an election with the IRS. It doesn't affect any other legal requirements with the state. The benefit to the S corporation is that we don't have that double tax that we have with the C corporation. The income of the corporation, similar to a partnership, just simply flows through to the shareholder and is picked up as taxable income on the shareholder's tax return. The other benefit of the S corporation is that income that flows through to the shareholder is not subject to any self-employment tax. It's not subject to any payroll tax. The corporation does need to pay appropriate wages to the farmer shareholder, but is not required to pay all of it out in the form of a wage. And that's the other drawback of a partnership, is all the income of the partnership would normally be subject to self-employment tax too.